Why did the relief rally fail? How much higher are interest rates going? How am I shorting this market? Hang on.
This is not financial nor professional advice. This video is for entertainment only.
Hey everyone. On Tuesday, July 12th, we got a fake report that hit the media that the inflation report, the CPI, was going to be over 10%, and that wasn't correct. And the White House tried to deal with it, but still set the stage by telling us that it was going to be high, the CPI. And so on Tuesday, I sold the stocks I had been trading. They weren't doing very well anyway, and I bought back into SQQQ, which is shorting the 100 largest companies on the NASDAQ. And it turned out to be a very fortunate thing to do. The next morning, it shot up tremendously, and I made a lot of money. And I traded it on and off during the day. This is such an unstable market. I can trade 3 or 4 times during the day and make money. And I bought some right at the close, and of course, in after hours, it's gone up. Because on Wednesday, when the consumer price index came out at 9.1, which was high and more than expected, so it was worse than expected, but it wasn't outrageous. But the market, it went down a little bit, but not very much. It went down enough to notice, let's put it that way. But I think on Thursday is when people are going to read this, and they're going to read it right. And we're getting reports that the Federal Reserve now wants to increase the interest rates to 0.75, wants to increase to 0.75 of an interest rate point, but they are considering probably raising it a full 1%, which would be the largest increase since the 1980s. In fact, as I'm trading, I feel like I'm back in the 1980s. It's so similar. And I think it's going to get worse, and let me tell you why. So what I think is going to happen is when the Federal Reserve meets in its meetings at the end of July, on the 26th and 27th, they're probably going to raise it 0.75 of a percentage point, but they could raise it a full 1%, which would be just wild for the market. It will crash the real estate market, or at least bring it down significantly. And they're probably going to increase it again in September, although at a lesser rate. Now, if they would increase it 0.5, that would be what's expected. If they increase it 0.225 or less, or don't do anything in September, that would be bullish for the market. But what's happening is, I think you had the strange effect today where the market went down, but it didn't totally crash. And I think that's because I think the bond market is predicting what's going to happen. The bond market thinks that raising the interest rates will crash the market and will crash real estate, and that the Federal Reserve will have to reverse the rate increases next year. In other words, they think in 2023, the Federal Reserve, because they raised things so much, the economy is going to crash. We're going to go into recession, maybe severe recession, and the Federal Reserve will have to bail the economy out by cutting interest rates. And so that's why the 10-year and the 30-year interest rates have been going down, because they're saying, hey, look, the long range view is we're going into recession, so interest rates are going to come down. Meanwhile, the short range view is the Federal Reserve is hell bent on raising interest rates. And so you have the 2-year interest rate paying higher than the 10-year, which is an inversion of the yield curve, which just about always predicts a recession. And it's been inverting so strongly and so often that it would be unusual at this point for us not to have at least some kind of recession. And now you have people that normally don't agree so much with each other agreeing on some things. And I think a notable agreement is the possibility of disinflation due to the Federal Reserve crashing the markets and are going into a recession. So instead of inflation, they have to cut the rates, and we actually go into disinflation. In fact, we're already starting to see that. Copper prices, which are seen as a good gauge of the economy because it's used in so many electrical components, copper prices have come down. Lumber prices have come down. The gas prices have come down because of decreased demand. Although I think oil is very hard to predict, just given the geopolitical situation and the war in Ukraine. So it's hard to know exactly how that's going to come out. But basically, what's happening is the Federal Reserve is crushing demand. And both Michael Burry, he's predicted the Great Short, the movie that was made in 2008. He predicted the real estate was going to crash in 2008 and would bring everything down. And so he shorted everything. It was called the Great Short back then. And then Cathie Wood of ARK Investments, who she's been predicting disinflation for quite a time now. And it turns out that she's going to be right on this. And Michael Burry and Cathie Wood got to the same place by vastly different styles of thinking. But basically, as they raise interest rates, that makes the dollar stronger. The strong dollar is crushing foreign economies. Anybody that owes us money, things that they buy from the United States are going to cost them more. Things that we buy from other countries are going to cost less, and that's why it fights inflation. But it makes it very hard for companies that export from the United States to foreign countries. It makes it very difficult for them to make a profit. So the strong dollar, I mean, it's going to crush exporting companies. And so, a lot of the large technology companies, they export a lot to foreign countries. And so that's going to cut down on their profits. And so basically the strong dollar is going to crush things. And we can see this in a chart of UUP. And let's look at that. The Invesco US Dollar Index Fund is a good way to track how the United States dollar is doing in comparison to other currencies. It compares the US dollar on a long-term basis to the euro, the Japanese yen, the British pound, the Canadian dollar, the Swiss franc, and the Swedish krona. So it's a good gauge of how the dollar is doing worldwide. And as you can see, it's done quite well. It's gone up over 12% since the beginning of the year, which is quite a lot. One thing that makes me think the Fed could increase interest rates a full percentage point towards the end of July is because Canada just increased their interest rate by a full 1%. And other countries around the world are starting to raise their rates as well. So the Fed is taking notice, and it sort of gives them more permission to fight inflation, which they say is their number one objective right now. In many ways, we are living through unprecedented times. I mean, it reminds me of the 1980s in some ways. But in other ways, it doesn't. Simply because of the cause of this is the monetary policy where they pump so much money into the economy. The Fed literally was just printing money wildly. They had the money printer on full blast, and they pumped $6 trillion into the economy. They were so convinced that the pandemic was going to take over the economy that they more or less replicated the economy for a year or two. And so we got this very wild situation. And when you print that much money, Milton Friedman used to say this all the time back in I think it was the 70s even. He would say that inflation is always a monetary phenomenon. It's caused by printing too much money that isn't backed up by debt. And every money is backed up by debt. That's the basis on which they create money. When people buy houses or cars, the money is backed up by those houses and cars. It's also backed up by your credit, by your promise to pay through your work, that you're going to repay this debt you created, and so it's all based on debt. They had to go off the gold standard. How in the world's name could you back up every asset by gold? There isn't. I don't think there's enough gold in the world to back up all the assets. But if you make the assets the backup for cash, that's sort of the perfect solution. And so that's why they went to that. 2022 will always be remembered in my mind as the year I was deeply rewarded for shorting the market. I'm normally not a shorter. I don't like to short individual stocks. The only time I will short is when we're in the middle of a crash and it sends everything down. And so it really doesn't matter that much what an individual company does, because everything is going down, even companies that do well. It's just that the companies that don't do as well will go down even more. But when it's such a general malaise like this and things are going downhill, it's just simpler to short an index fund by using an inverse fund. And I use the triple leverage inverse fund, SQQQ, which is a triple leverage inverse fund on the 100 largest companies on the NASDAQ. The QQQ is the 100 largest companies on the NASDAQ, and the SQQQ simply shorts that. And they do everything for you. You don't have to do anything. You just buy it and sell it, and it's easy. And I've made like 190,000 since the beginning of the year, and that's over and above what I've lost trading other stocks. Okay, I play the hills and valleys of the SQQQ, and I've gotten so used to it. I've tried shorting other things, but I don't do as well. I've gotten so used to the SQQQ that I know its movements and how it moves pretty intensely. And so I will trade it 3 or 4 times in a day even. And every time I've been trying to play a rally with regular stocks, stocks that I love, like solar stocks, it has not worked out and just created losses, which I then have to make up using SQQQ. And SQQQ always does that. So I'm pretty much done buying individual stocks for now. I think we have a rough month or two ahead of us, and maybe even longer, depending on how things pan out. Usually the bear market reaches its bottom when we've reached the point where we're in deep recession. It starts to pull out of it once the Federal Reserve starts to reverse its interest rate increases and actually starts to decrease interest rates. So until then, I'll be playing the SQQQ. And as we look at the chart of the SQQQ from the start of this year, the year-to-date chart, we can see that it's made over 84% since the beginning of this year. And I've actually made more than that, simply because I play the hills and valleys, and I can do it a couple times a day. And I've been very lucky, and I realize that. And I'm just so grateful for the existence of these inverse fund, which is really the only thing that's worked for me this year, but it's worked in a big way. Sometimes you only need one good idea to get through a difficult situation. Thanks for listening and watching. Be sure to like and subscribe if you've gotten anything out of this and you want to receive notice of future videos. Good luck to us all investing. We're going to need it. I think we can have a way to make it through this mess, but it's going to be a rough ride, at least for a couple months here. But I think we will pull out of it, and eventually it will be time to invest and for it to be fun again, rather than an excruciating worry about what is the market going to do today. You know, I'm looking forward to those times. I think they will return. It's just we got a rough patch to hold for a while, and we got to hang in there and do what we can to make money in the meantime, because we want to have money when it does turn, because when it does turn, it can be explosive. And part of the reason it's explosive is because shorters like me get out of the market, give us a clear sign that things are in the clear and we're out of there. and I will swing. I can swing both ways. Okay, I will swing the other way as quickly as possible. And I don't like shorting. It's much more fun to be in an explosive market that's explosive because it's going up and not because it's literally exploding. Good luck to us all. Bye-bye.